Hi, everybody, and welcome to my session on the private wealth and private equity markets. And we'll take a few minutes to look at various asset classes, and especially the new and emerging asset classes on private equity. And we'll also do a bit of touch up on crypto and the new asset classes that are sort of gaining emerging investor interest in the last few years, and especially the last few months on top. So quick recap. I have seen in the business, I have been in the business now the last close to 30 years. Worked in New York, London, Zurich, Mumbai. There was a bit of Tokyo, and during this time I worked with Merrill Lynch, Credit Suisse, Deutsche Bank, Julius Bär, EFG Bank, and also with some boutique asset managers like Lakefield Partners along the way. What I have seen during this time, not only is the changing sort of dimensions of what is asset allocation and how high net worth and client families are looking at building their portfolios, but also taking a sort of deeper look as to how asset allocation has changed over time in the last 2.5, 3 decades, coming from a sort of traditional, 3 building blocks of asset classes, and moving on to, adding 4, 5, or 6 asset classes. And what is the optimal point of where you start to not compromise on the outperformance, but at the same time still keeping the risk under control. And that's a delicate balance, naturally, when you look at a combination of the traditional asset classes with the emergence of real estate as a large part of the asset class segment. Families also look at alternate classes, hedge funds. Also, we look at, there is a small percentage who also look at sort of art as an asset class, and antique cars and other antique valuables from time to time. But in essence, one key component that has remained always sort of omnipresent is private equity in the last all these years. And private equity has been gaining importance and a fairly steady chunk of client portfolios over time. And its emergence in the last sort of decade or so has got a square place in the portfolio. It could vary from 5% or even closer to double digits in some cases, depending on the client's sophistication and their experience with the asset class. So keeping that in mind, we've seen a sort of steady increase in the returns. High single digits, or even in typically lately we're looking at even 10 to 15%, might I say, in some cases where clients are getting returns in their portfolios when we look at the component specifically on private equity. Now, these investments by definition are outside the publicly traded markets. Clients feel that we can approach these entrepreneurs and the people behind these ideas, we can approach them directly, participate in them directly with private money. Typically, these structures are, if you look at the general partners, the GP and the LP, the limited partners, who are usually sharing the other 99% or 98% of the equity ownership of their structures. And where you are looking at returns is where you're able to see that this is going to give you the alpha in your portfolio relative to the other asset classes of equity markets and bond and debt instruments and cash equivalents in a portfolio. So the dynamic and this sort of might I add, a delicate balance from time to time of asset allocation is a dynamic wheel. And one has to look at it, how this is moving and being readjusted, recalibrated every year, every quarter, if need be. And the calibration keeps you as a financial advisor, as the wealth manager, ahead of the curve. and your client is looking at you to do this calibration, it may be 1 or 0.5% or a slight degree of calibration, but to keep your sort of ship steady and through the volatility in the market and through the various swings and that keep occurring every now and then in the markets. We're not talking about single markets, we're talking about interconnected global markets. And within global markets, naturally, you've got an increased pressure of the dynamics of macro events, the dynamics of various events, including geopolitical events. 2020 has been a powerful year when you look at in terms of data. Good and bad. It's been a very dramatic year in terms of all what has happened in the markets. Investors have seen phenomenal returns in the direct equities this week. Worth mentioning the Dow hitting 30,000 on the Dow Jones, various other indices hitting record highs, and at the same time, you're seeing a remarkable gap that is increasing between the fundamentals of the market and where the valuations are. And I think this gap is where investing families and clients and private wealth managers are watching it carefully, that how to de-risk this gap in the market between fundamentals and valuations or stock prices. So I think that's where private equity begins to take a bigger role in a client's portfolio. A bit more predictable, a bit more heavy money, larger allocations, which is sitting as a sort of bedrock of investments. Longer term, 5-7 years, possibly more in some cases. And that is where you see the importance of private equity playing a role in clients' portfolios. Now, this is crucial when you look at what our clients generally seeking. Typically one looks for investments which are similar to your risk appetite or to your investing experience over time. For example, there is a lot of very interesting deals coming in the market in medical technologies or in biotech or genetic tech or gene tech. All these developers and the breakthroughs are being channeled into very innovative products that are coming in for the healthcare sector. And a lot of investors are willing to sort of bet money on this and put money on this and be early stage. Some of the bigger technologies are very high tech, in some cases very dramatic. If you look at satellite technology or rocket technology, there are some names that are quite popular these days that people are looking at, these brands, companies that are doing, fantastic work. SpaceX is a live example, and there's a lot of new emerging rocket tech companies that are coming up, which are doing also fundraising in the market. Another key section of private equity that is getting interest in clients' eyes, we can look at the health and the well-being and the healthcare section. Now, well-being and health is a huge area, I think, this year, because not only are the general public and people are looking to have a greater awareness of their own health, but public health as well. Needless to say, the pandemic has created a huge buzz, both demand and supply in the market. The systems being stretched and pressured to its seams, the healthcare system, the medical system, the medical infrastructure. But at the same time, you're realizing that the average person, family, is realizing that I should do a bit more for my immunity. I got to eat healthy. What am I eating? What am I putting in my mouth? What can I eat of a better, healthier quality? What can I eat more nutritious that is going to boost my immunity? What steps can I take at my level? Try to minimize medication and those things where possible. So there is a lot of work going into like well-being and healthy startups, healthy food startups. So that's another area that I think is definitely going to gain interest and in investor attention, where people will look at well-being in healthcare, superfoods and more sort of a nutritious foods and clean foods. That is the entire food chain is being re-examined, and I think a lot of investors wish to participate at various cycles of this stage of how food is created, how food is packaged, how food is presented to you as a consumer, and how are you, able to, how much are you eating of it? So all of that, I think, is clearly a space which is growing in importance from investing standpoint as well. Investors are looking to get in early, literally greenfield at the farm level, land and farm level. We are working with the client families where we're looking at from farm to fork, to the table basically. And we are working with them to look at entry points in the various cycle of this, the entire cycle of food development, food preparation, and clean, healthy superfoods until they get to your table. So that's clearly something which we're looking at. There are other startups which are looking at the 360 degrees of the full healthcare. We're talking about the electronic side, the multimedia side, from apps to scientific, all these apps and the interconnectivity or the Internet of Things, of how you're able to blend in the fitness along with the diet and intake that you're putting in your body. So we've got either separate companies or we've got the same companies who are trying to capture this market. There's really some interesting, exciting players who are doing great work in this space. I don't want to start recommending names, but yeah, there are some interesting ones who are already taking leadership roles in this space. That's one area. Moving slightly a bit on the left or the right side, let's take a quick look at crypto. This whole space of crypto coins and crypto bitcoins and the various other coins out there, using the blockchain methodology or the digital ledger technology. This is, I think, clearly a groundbreaking new stage that we have seen from an investing standpoint, and one that is clearly going to be a paradigm shift. The way we used to do banking, financial services, and the way it's going to evolve into. So I think the blockchain technology, I'm a strong believer. I think this blockchain technology is here to stay. It is a very powerful technology. The Bitcoin sort of iteration is only one variation of implication or the application of this blockchain technology. But if you look at the world of the emerging world of decentralized finance, these are areas that are becoming more and more interesting. Clients are asking questions. Clients are more curious. They're willing to, take a look at it, but potentially even start putting in 0.5 to 1% of their holdings in crypto assets. So I think, the question remains: is it too early to call it an asset class? Possibly. If you ask a sort of, if you ask a traditional banking person like me, I think it's a bit early to call it as a fully defined asset class. But on the other side of it, I think this is clearly gaining investor interest, and not only investor interest, but the regulators' interest as well. And let's not take that lightly, because I think you've got an existing regulatory framework, the way the fiat currencies interact with each other, the way global financial markets interact with each other, and the way global money moves around the world in the bloodstream. And now we've got a crypto environment which is being built and created very rapidly, sort of like a parallel financial system. And this is gaining interest. And I think increasingly we are getting interest from client families and high net worth and family offices who are seeking to get in on this early. It's not too late. Is it too late? I think it's still pretty early stage because the regulatory framework hasn't yet been defined as well. Some governments, some state legislatures in various countries are beginning to take a look at it very seriously, slowly, carefully allowing it to be blended in or meshed in with mainstream financial instruments. So I think that is clearly something of interest. Both from wealth managers and even banks are looking at it quite carefully. Some of the big banks have gotten into it very aggressively. They are willing to allow clients to hold positions in it. And so we will definitely see more and more of the crypto space. The question is, when you ask from an asset allocation standpoint, okay, how does this blend in? Well, even if you look at 0.5 to 1% of your portfolios going into crypto, that's a sea change. So I think all of you start to see a greater space of the crypto assets, a greater space of even coming in from 0.5 1%, possibly more, depending on whichever crypto asset you're looking at. But blockchain driven, or if it's Ethereum driven, architectures behind it, which are validating the contract between the two parties for the monetary value to be exchanged. And I say monetary value with quote marks because naturally it's the value that is being locked and transferred from handshake to handshake, and I mean digital handshake. So I think clearly that is a space where we will see more interest. We will be getting more inquiries from client families and family offices willing to look at the space of crypto assets. And going back to sort of touch quickly on the private equity side, I believe this is slowly we are getting to the blended approach of a larger portfolio construction methodology where you need to justify a larger space of private equity. 5%, 7%, 8%, depending on the client's risk appetite and experience. Clearly that is worth looking at. Find the right kind of private equity deals. I don't want to understate the importance of ESG and sustainability investments. There is a huge demand in the market that is accelerating every month. And I think projects which involve water, electric, solar, from farming, and even the whole range of other UN SDGs, these are clearly areas where investors need capital. Entrepreneurs need capital, they need the buy-in. Some of these projects are interesting, some of them are very niche products. But clearly, I think this is ESG products, generally end up in the space of private equity. And this is where I think it should be encouraged. And I ask fellow, my peer group in the wealth management industry to encourage clients to take a look at these investments more sort of, carefully, and review these opportunities that come along. Because I think sustainable projects in the whole range of field of these from water, electric, solar, environmental, and the various other fields is clearly necessary at this stage should you wish to invest in private equity. The world, we're getting a lot of pressure on climate change, and it is squarely on the table of an important part of the conversation. And I think wealth management and banks and bankers should clearly be part of this conversation, should assist in guiding clients towards investments where you have deep, clear metrics that can be measured, reportable, using external software or otherwise, but it should be, this data has to be captured. There is still clearly a gap on private equity part where the ESG data is not yet reportable. But I think clearly there is work being done in that direction. So I would encourage, I think we need to involve and include various people in this discussion and create not only healthier portfolios, which is something we do every day, but I think more robust dialogue that needs to happen in this space. And our role in wealth management, working with family offices, working with clients, is to channel their allocations in the proper way, sensible way, a more proper discussion comes along, not only in portfolio building, but their contributions back into the world at large. That's something which I do and something which I encourage my colleagues to participate in and do more of. That's it from my side, and I am available on my LinkedIn profile, and happy to take any questions and feedback at the end of this in our panel discussion. Thank you very much.